Welcome to this month's Market Update. I'm here today with Dr. Vivian Xu, a member of Frontier Advisors Capital Markets and Asset Allocation team. Hi there, Vivian.
Hi, Wei.
Well, certainly a lot to get through. There's a lot happening. Some challenges in some markets, some positive results in others. How about we start with what's been happening in the US?
Sure. The U.S. equities in the past month have seen weaker performance, mainly because of the drag from the technology sector. And that came from, it all started from the announcement of DeepSeek, and there's the market question of U.S. exceptionalism, and potentially triggering the readjustment, revaluation of the entire technology sector.
Yes.
And that weak performance in technology sector has weighed on the global equity index. And we've seen the global equity markets actually delivering a weaker performance than the strong start in January. So that's one thing. And another thing that drives the U.S. Weaker equity market is the growing concern over recessionary risk and higher inflation concerns. We see the consumer sentiment index in particular has been declining sharply in the past 3 months, which is reflecting the Trump's administration policies have triggered the market concern over the growth outlook.
Mm-hmm. So continuing to travel south here to Australia, our market here, some not so great results for the share market in Australia, but a much anticipated announcement from the RBA.
Yes, the RBA has finally delivered its first interest rate cut since 5 years ago.
Yes.
This is quite exciting news for growth assets domestically. And although RBA do suggest the continuous rate cut is not guaranteed and will be subject to inflation rate. Despite the interest rate cut, the stock market domestically has saw a decline, and that is broadly aligned with the global stock market and was mainly impacted by Trump's policy and the concerns over growth outlook. The Australian dollar has also taken quite a hit in recent months. It has been declining sharply, and this was driven by a number of factors, including facing a strength of the US dollar, and we're seeing the iron ore price have been on a constant decline. And, of course, the weakness in domestic demand in China, which is our largest trade partner.
So equities markets have handed back some of the gains that they generated in the first half of the financial year. That's not so much the case for fixed income assets, is it?
That's right, Glenn. The fixed income assets actually saw solid performance in the past month, which makes a good diversification from, the equities. The sovereign bonds, global bonds, the U.S. bond in particular, has seen large volatility in the past several months. The U.S. 10-year Treasury yield increased sharply before Trump's re-election, and that was a reflection of the market's expectation of Trump's inflationary policy. Entering 2025, however, we've seen the U.S. Treasury yield dropped sharply, and it is now around 4.2%. The decline in the bond yield, as we look at the breakdown, is mainly driven by the real yield, which can be interpreted as the market is doing a reassessment, and according to the Trump's potential policy and the growing uncertainty driven by geopolitical tensions and heightened market risk.
So we're seeing different directions within sectors. We're seeing the benefits of diversification. There's a lot for you to be across. Busy time for you. Thanks very much for your update today, Vivian.
Thank you, Wei.
And thanks to you for watching this month's Market Update.